Hello folks, this is Tom Hall with Tom K. Hall Financial Group with an educational economic update for March 2018. In this month's video, I'll discuss some of the major headlines that influenced markets in February. I'll also provide insight into what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. Domestic markets started 2018 with their best monthly performance since 2016, only to stumble in February. Both the S&P 500 and the Dow had their first monthly losses in 10 months, breaking the longest winning streak since 1959. Overall, the S&P 500 lost 3.9%, the Dow dropped 4.3%, and the Nasdaq gave back 1.9%. These losses came as volatility picked up throughout the month in early February. We experienced back-to-back stock sell-offs followed by large jumps. During 1 week, the Dow lost 1,000 points and gained back 300 twice. But this volatility wasn't the result of negative economic data or geopolitical problems. Instead, a combination of emotional investing and computer-generated trading may be to blame. Essentially, investors became concerned about inflation when the Labor Department indicated that wage growth was picking up. In other economic news, we received a variety of positive and negative reports. The most recent data for housing showed both new and existing home sales dropped in January. Housing starts, on the other hand, hit their second highest rate since the recession. We also received the second reading of the fourth quarter GDC, or gross domestic product, at 2.5%. The growth matched expectations. Ultimately, though, worry about inflation and the resulting potential for interest rate increases contributed to much of the month's volatility. By the end of February, comments from the new Federal Reserve Chair, Jerome Powell, led some investors to believe that interest rates may in fact rise faster than anticipated. In testimonies to the House Financial Services Committee, Powell spoke of growing global strength and stimulative fiscal policy. He also said that inflation may be moving closer to the Fed's target rate. This positive view of the economy could potentially result in 4 interest rate increases in 2018. On February 27th, stocks dropped significantly in response to Powell's testimony. The volatility continued the next day as stocks whipped back and forth before ultimately ending down. If February's volatility feels unnerving, that may be due to the market's unusual calm since 2017. Since 1980, the average annual S&P 500 correction has been approximately 14%. Last year, however, stocks only fluctuated 3%. When considering last month's fluctuations, remember, positive economic perspectives were behind much of the movement. Despite the volatility, consumer confidence easily beat expectations and showed that people still feel particularly good about the labor market. Jobless claims also supported this perspective as new unemployment filings remained near historic lows. As we move further into March, we'll pay close attention to inflation, interest rates, and investor behavior. On March 21st, the Fed may raise interest rates again and provide greater insight into their expectations for the year ahead. As developments arise, we will keep you informed. That's it for this month's economic update. Once again, this is Tom Hall with Tom K. Hall Financial Group signing off for the month of March 2018. Please remember that nothing we talk about here is a recommendation for your personal situation. If you'd like to discuss your personal finances, please give us a call at 801-316-4110. We'd be happy to talk to you. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results.